This is an introduction to Chapter 12, Partnership Accounting. Use the same accounting equation, except there are two or more owners. Not a sole proprietorship, but two or more owners. So a sole proprietorship had one owner, owner capital A and owner equity as a permanent account. A partnership will have two or more owners, each with their individual owner capital account on the owner's equity. All other accounts on owner's equity are the same: revenue accounts, expense accounts, and a drawing account for each partner. So same equation structure for partnership as a sole proprietorship, except multiple owners. Now, a partnership having more than one owner has to decide how to allocate profits among partners, how to account for the admission of a new partner. Every time a new partner comes in, an existing partnership is dissolved and a new one has to be formed. Furthermore, a partnership agreement has to provide for withdrawal of a partner and any final liquidation of partnership. You'll want to concentrate on these last four objectives. I'll let you read about the characteristics and type of partnerships, but I do want to point out a couple characteristics. First of all, partnerships have a mutual agency for all partners. What does that mean? All partners have an unlimited personal liability. If a person sues a partnership and there's not enough assets to cover a successful suit against it, then the individual partners can be sought out to provide the difference. So, just like a sole proprietorship, partners have unlimited personal liability that goes beyond the assets they have invested in the partnership. That is a limitation of partnerships, just like it is in corporations. Just like it is in sole proprietorships. So partnerships as well as sole proprietorships have this unlimited personal liability, meaning that the personal assets of the owners can be gone after if there's not enough in the corporation to satisfy, let's say, a suit. But partnerships, like sole proprietorships, pay no business income tax. Just like a sole proprietorship, the profits of partnership are reported on the individual personal tax returns of the partners. There's not a separate income tax paid as corporations. A regular corporation is a separate legal entity, and it does pay a business tax apart from the then any income tax on dividends paid to owners. The chapter does cover a discussion that certain partnerships can be brought about as a legal liability company. That means that it can limit the liability to partners' investment in a partnership, except there must be one general partner to cover any need for capital beyond that. Limited liability companies do not pay any separate entity tax like general partnerships. There's also something known as an S corporation, special in the sense that it is a separate legal entity, limited liability, but it does pay no business income taxes. I'll let you read about the characteristics of that S corporation. But in general, partnerships have unlimited liability. They're not a separate legal entity, and they pay no business income tax because there is no separate legal entity involved. Let's begin to look at the decisions a partnership has to make, for instance, allocation of profits and losses. So a partnership agreement must specify how the partners will split profits. For example, let's say two partners, 50-50 split of profits. Another way that could be stated, by the way, same as 1-to-1. That is, two parts of the partnership, each partner receiving an equal share, 1-to-1. Simply add up the parts, total of 2, 1/2 and 1/2, 50-50. This ratio can be whatever the partners desire, 50-50, 60-40, 70-30, 80-20. Likewise, if there are more than two partners, let's say 3, and they all want to share equally, that can be specified as 1-to-1-to-1. Total of 3 parts, each getting 1/3, or 100% of the profits are distributed equally. Another example of 3 partners, let's say the profit sharing ratio is 1-to-2-to-3. How do we interpret this? Add up the numbers, total of 6 parts. Partner 1 gets 1/6 of the profits. Partner 2 gets 2/6. Partner 3, 3/6. Again, adding up to 100% of the total profits. So this partnership profit sharing ratio can be whatever the partners decide, as documented in the partnership agreement. Every time there's a change in partnership, a new partnership agreement must be written up. Let's take an example of, for an existing partnership, accounting for the admission of a new partner. There's a Momentum handout about purchasing into a partnership, which you should consult. Now, anytime a new partner is admitted, as mentioned, the old partnership is dissolved, and any new partner needs the approval of all the other partners. So, how can a new partner come in? What are his options? 1, he can buy an existing interest from another partner. That's a very simple accounting. If a new partner buys an existing interest, it's a personal transaction between the incoming and outgoing partners, and not with the partnership itself. It needs the approval of the other partners, but this just is a matter of exchange of cash between the new partner and the outgoing partner. We need a journal entry, but it's very simple. First, to point out, if it is a new partner coming in buying an existing interest, there's no new cash coming to the partnership. The exchange of cash occurs outside the partnership among the partners. The only entry on the balance sheet of the partnership is to remove the old partner's capital balance, debit it, bring it down, and replace it with the new partner's capital. Again, the purchase price of this is outside of the partnership. If a new partner coming in is simply buying an existing interest of a partner that's leaving. Again, total assets of the partnership are not affected by one partner coming in by buying an existing one. Simply a removal of one capital balance, replacing it with another on the partnership books. Second way of coming in is for a new partner to contribute assets, usually cash, to the partnership. Now, for a new partner to come in by contributing assets, this option has many different flavors that you need to pay attention to in the chapter. So, let's look at the various options that exist when a new partner comes in and contributes assets, usually cash, to the partnership. First of all, the amount of the partnership, the purchase price, has to be determined first, usually negotiated. Now, let's take the easiest case, A, that whatever the price is negotiated, the new partner pays the book value for it. Take the example of a new partner coming in, and the negotiated purchase price is $100,000 cash paid to the partnership, and they're going to give that new partner the book value of that investment. Simple entry. Cash comes in, $100,000. New partner capital. Account is credited for $100,000. Done. Book value. The new partner is given the book value of the assets he or she is contributing to the revised partnership. Different scenario. The new partner pays a bonus to existing partners. It's demanded of the existing partners for that partner to come in. Second scenario, the new partner pays a bonus to the existing partners. Let's take the example of the same purchase price, $100,000, that's coming into the partnership. But the existing partners are only going to give credit of $80,000 to the new partner. That means the additional $20,000 is split up among the existing partners capital accounts as a bonus. However many existing partners there are, it'd be according to their existing profit sharing ratio before the new partner comes in. So, example of B is a new partner comes in, they pay $100,000 for a share, but they're not given the book value, they're given less than book value, and therefore the difference goes to existing partners as a bonus in their capital accounts. The third scenario that can exist, a new partner, he or she gets a bonus from the existing partners. Yeah, the newbie gets a bonus, not the existing partners. Let's say the existing partners want this new partner to come in, and they'll give him or her an incentive by giving them a bonus. So let's look at that example journal entry. Let's assume the same purchase price, $100,000, that comes into the partnership. But to entice this new partner, they decide to give that new partner a $120,000 interest in the partnership, crediting the new partner's capital account. That means the other $20,000 needed as a debit would have to come from the existing partner's capital accounts. In other words, the existing partners have to reduce their capital balances in order to give that bonus to the new partner. A $20,000 bonus comes from the existing partner's capital. They give that up, their share, to the new partner. So 3 scenarios. The new partner buys in at book value, less than book value, gives a bonus to existing partners, or the new partner comes in with a bonus themselves, and the old partners give up a portion of their capital balance. In all cases, we send the same purchase price. It's all a matter of what capital amount is given to the new partner. That is negotiated. Just to summarize those 3 scenarios, A, B, C. A, the asset coming in, full credits given to the new partnership, book value. B, the new partner pays a bonus. To enter into the partnership, so therefore the assets coming in, the new partner is given less than that value, and the difference goes to the existing partners. So bonus to existing partners. Or C, the new partner coming in is given an incentive, and whatever they contribute, the new capital partners account is credited for more than what's coming in, and the difference has to be debited or given up by the existing partners. 3 scenarios, 1 purchase price, but how much ownership interest in the capital account is given to the new partner. 3 different scenarios. Here's a general rule at the bottom for a new partner coming in and contributing assets to the partnership, and the negotiation is other than book value, so other than scenario A. So here's how scenario B and C would be handled in all cases. 1, add the negotiated purchase price to existing capital accounts. Example, an existing partnership of A and B, each with capital balances of $120,000 at time of a new partner coming in. The new partners purchase price is negotiated $100,000. So we add up all three of the capital balances after the contribution, $400,000 in total. Second step, multiply the percent interest granted to the new partner to obtain the new partner's capital balance. So the $400,000 total new capital balances, let's say it's negotiated that the new partner is given 30% interest. So 30% times $400,000, the new partner will be given $120,000 credit for their $100,000 purchase price. So cash coming in, debited $100,000. The new partner is given negotiated interest of $120,000, in other words, a bonus, and the existing partners have to reduce their existing capital balances, and it's 1-to-1, it'd be $10,000 each. Point being is whatever interest share is given to the new partner versus the purchase price, the existing partners have to eat that difference and reduce their capital balances accordingly. Step 3. Whatever has to make up the difference, the existing partners, either they take the hit, or let's say, let me modify the example. Let's say C is given a 20% interest in the new partnership. That is only $80,000. So again, $100,000 coming in, the new partner would only get $80,000. And so the bonus would go to the existing partners in whatever ratio, capital profit sharing ratio they had before the new partnership is formed. These two accounts would be credited for $20,000, making up the difference. Again, if the new partner was given a lower percent than what they contributed, given a partnership interest of 20% when they actually contributed 25%, not book value. So again, to recap, this rule is for a new partner coming in at different than the book value of their purchase price. 3 steps to follow to make the journal entry, booking the new partner's interest and distributing the remainder to existing partners, either as a bonus or as a subtraction from the existing partners. Be able to handle this scenario in Chapter 12. We'll cover learning objectives 5 and 6 in a follow-on talk.